is when I make the joke, I'm out of the house and away from the testosterone. So I'm, again, Naomi Blohm, and I'm from Wisconsin, Fond du Lac. Married, we have 2 boys. Oscar's going to be a senior. Orville is going to be a freshman. And so life is good and life is a lot of fun. If you haven't heard me speak before, I'm going to give you just a quick background story on how I got into what I do, why I do it, and I know some of you have heard the story 5 or 6 times, so bear with me. But growing up, I grew up in Cambridge, Wisconsin, which is just outside of Madison. So growing up, my dad and grandpa had a dry dog food business in our backyard. So this is before the whole pet food industry exploded. And they were definitely a little bit ahead of their time. So growing up, I was the dog food princess. Super flattering. I mean, it's, you know, not like an Iowa beef queen or anything like that. But anyway, that was a running joke. But anyway, when I was going to college at Platteville, my thought was going to go into agricultural law because I enjoy the politics side of it. I enjoy agriculture. Turns out I have a personality, so that's natural. Anyway, so where I got into more of the commodity side of it was in 95, 96. So think of my dad and grandpa as end users. We have to buy corn and soybeans to put into our dog food. And this is, no preservatives, anything like that. So in 95, 96, the price of corn had been at $2, and that was the first time it had gone way up to $5. So they weren't ready for that. And when I was in my college classes, we were talking about it, and the kids in my classes were talking about it in my agriculture classes, and parents were arguing and fighting, and kids were stressed, even not being at home, being at college. So my dad, as an end user, just was feeling deflated, because he, what do I do with this higher price? Do I pass it on to the customer? What do I do? And then my college peers were on the other end of the spectrum if they grew up with farming, because they were saying, well, my parents are mad because they sold all of their corn at $2 and now it's $5. So that is what got me into commodities and commodity marketing, because I really understand how it can affect both sides of the equation, from the end user, from the family farm, the family fights that happen from it, the uncertainty and the stress. So that is my background. And speaking of stress, how about these markets? Really? Super! All right, we're going to get right into it. And I'm totally low-key. If you have a question while we're going, shout it out. That's no problem. If you want to wait until the end, that's fine too. I will kind of point out times where you're going to want to take notes on things, and where you... There. Okay. So right now we have a big clash, bullish or bearish, with the marketplace. We just came off of a bull market last year and the year before, and now we're at the point where it might turn bearish, really bearish. So I'm going to give you some things to think about, not only for the rest of this year as we head into harvest, but what to be thinking about into 2024 as we start to think about marketing that crop. So today we're really going to focus on corn and beans, and I'm going to touch on wheat and a real quick touch on cattle. But these are the unanswered questions that we're still dealing with, and it's not going to go away anytime soon. And at any one time, these things can flare up and for no reason make the market just go racing higher or make the prices crash lower. And so it's really tricky to understand what you should be watching for, and we're going to cover all of these today and help you get a little bit better focus on where markets might be going. So we're going to start with outside market influences, the chess match of the world with all of these factors that you hear about maybe on TV, but you're not maybe sure what it is or why. So component number one. This is a chart of the value of the US dollar index. So when you look back here, this goes back to the year 2000, and every vertical black line on here represents the high price and the low price of the dollar for a month. And here's the value of the dollar. Just the one thing that you want to remember is that, and this is your only takeaway. So if you wanted to take a note, this is the place to take a note. When the value of the dollar is down, that's good for agriculture because it makes it cheaper for countries to be able to import our product because of currency exchange rates. So a low dollar is good for exports. And what you'll notice here is that ever since 2020, the dollar, of course, has been going higher. Part of it in response to COVID, part of it in response to all the things happening around the world. And right now, the dollar is just hanging tight. Ooh, sorry if I just flashed somebody in the eye. Right in this level. When it dipped below, we had a nice week of exports, and now it's kind of creeping back up. This is another thing that we're dealing with is inflation. So now let me explain to you what you're looking at here. Inflation is painful for all of us. We were just talking minutes ago about how prices at the grocery store are still out of control and in some places getting worse, it feels like. So inflation is everywhere. Interest rates are going higher. So what you're looking at here is the interest rates by the Feds in the red line. And the blue line represents the funds. That's the big money in the marketplace. That's 401ks, mutual funds. Those are big, big money makers in the market. There's a very important correlation that I want you to be aware of. When interest rates are low, like they were in 2021, as we were coming out of COVID, the funds came into commodities to play. Because there wasn't, like, okay, so like, you know how you go to a bank and you put money into a CD? And right now, CD interest rates are, what, 5, 6? Pretty good? Okay, so that's easy money, right? So you can go put your money there and get a return on your investment for not doing a thing. So when the funds have low interest rates, they come and play in commodities, plus there was a nice story to tell a few years ago with the war. And they were buyers of agricultural commodities. They were buyers of corn, soybeans, Chicago, Kansas wheat, cattle, feeder cattle, hogs, cotton. So the blue lines represent how many contracts they were buyers total of. So big buyers means big prices in the marketplace. They are like kind of like speculators, and they come in and they help push prices higher. Now you'll notice that as interest rates have gone up, the funds have taken their ball and they have gone home because they can make money easier other places than deal with all of the drama and horse hockey that we are dealing with our industry. So that's just important to know because the funds are an important piece of our marketing puzzle. So just be aware of that. Here's another way to look at it. This is that same chart, but a little bit different. This is the money in the marketplace, the fund position. This red line is this year. This was the last 2 years. Blue is 2022, maroon is 2021. The funds had bigger positions in corn, soybeans, soybean meal, soybean oil, wheat, cotton, cattle hogs, and the prices were higher. Now, they are only a little bit more long or more buyers of the market than they were in early 2020 and right after COVID broke out. So they are really not hanging out with us right now. And that's just important to be aware of. We have political drama nonstop. Of course, you know the relationship that now China and Russia are dealing and building. NATO is a big thing. Russia attacking on the Danube River near a NATO country, trying to provoke war and bring all the NATO members in. We have a US election coming up. We have the Ukraine president, we have the French president, and the Canadian Mexican-U.S. relations, and North Korea, you never know, and OPEC and crude oil. So there's a lot of moving parts that actually come in and affect the value of the commodity just growing in your backyard. And I just want to really make that transparent going forward. Crude oil prices, that's something to be aware of just because a third of the value of corn is pretty much ethanol. Ethanol, of course, in energy, tied with crude oil prices. When crude oil prices go higher, usually the corn price is going higher. When crude oil prices are kind of trading sideways, sometimes the corn price trades a little bit sideways because it affects ethanol demand. Right now, crude oil prices since October have essentially been trapped in a range. This is a chart of New York crude oil prices. So every vertical black line on here represents the high price and low price of crude oil for a week, going back to October of 2020. Crude oil was cheap. Remember when COVID was going on and gas was like below $1 and it was like a ghost town? Then of course, we come out of COVID and then the war happens and we have $120, $130 crude oil, and now prices are just kind of stuck. So here's something important to know about stuck prices. $82 is resistance, and so that means the market has not been able to get through this price point. The $70 area is what I would call support, with a lower support here. Crude oil right now is acting like a caged tiger, the prices. So think of it this way. If you're a tiger and you're stuck in the zoo and you're just kind of going back and forth like this, if eventually someone gives you a reason to leap out of the cage, you're going to leap, right? Okay, so eventually this crude oil price is going to leap. It's going to happen probably in the latter part of this year. What I can tell you with confidence is how much lower or higher the price would go, but we need the fundamental reason to suggest higher, like if the war escalates, that would be a reason for the market to go higher. If suddenly Putin has to come to Jesus and just is nice and stops the war, that would probably make crude oil prices work lower. So crude oil prices right now, if crude oil has a reason, a fundamental reason to get above $82, take the difference between 70 and 80. What's the difference between 70 and 80? $10, okay. Now you're gonna add, and I'm rounding my numbers. I could specifically say 82 and 62, but for easier math, well, we can do $20. Anyway, so the upside would go up to like either $100 or $90, or if things like become wonderful in the universe, things are gonna slide lower. So the crude oil market is also dealing with this potential to be bullish or bearish. It's not just our industry. There's a lot of things going on right now where we're either gonna have crazy higher prices coming up in the next year, or things are gonna fall flat on their face for a lot of different commodities. Okay, now if you heard me speak at all over the winter, or even last year, I kept harping on, there's these 9 grain and oilseed commodities that have tight supplies, tight ending stocks. If ending stocks is a new word for you, you hear that on TV, they talk about ending stocks, they talk about carryout. It's the same thing. It means how much is left over. Leftovers, carryout, ending stocks. It's all the same thing. So right now, for old crop means anything you might still have in your bin. That's old crop. In this country, we have tight supplies of all of these commodities. Historically, the tightest ever. And that is why you had pretty decent prices for grain in your bin this spring and this summer. Yeah, there was price volatility, but your cash market overall probably stayed strong. And it's because we're tight on supplies. So how tight Let me take you back a few years and explain this to you. So for soybeans, in the 2019-20 crop year, 525 million bushels. Right now we're down to 255, so supplies are cut in half from a few years ago. Oats, tighter supplies yet from just years ago. Barley, tighter supplies from a few years ago. Sorghum, tighter supplies. Corn, 1.4 billion bushel carryout. What you're going to notice though is that these ending stocks are starting to creep higher from just a couple years ago. And here's what you need to know about ending stocks. Carryout, leftovers. Ending stocks, carryout, leftovers. When the pile is getting smaller, prices go higher. If the perception is that you got tons of leftovers, tons of carryout, tons of ending stocks, prices go down. That's all you need to know. Okay? So here we have of what's still in your bin, tight supplies. But now here's the part where we don't know what's growing in your field. So for new crop, so this is right now what is growing in the fields in our country. This is representative of your harvest price received at the elevator. December futures, November soybean futures. We're not sure what the yield is growing out in those fields. We know it was a hot and dry June and July. We know it's not a record crop, but we don't know what it is. So right now the USDA is saying all is fine. It's fine. Okay, and they're trying to say that the soybean supplies at harvest and when we get everything done is going to grow. Okay, so if we have supplies growing, prices go down. For oats, not too much growth. Barley, lots of growth. Sorghum, bigger than last year. Corn, this is death. This is the kiss of death. This number is bad. Like bad, like really, really big, and I have more slides coming on it. We'll talk about it. Wheat is still tight, and cotton is a little bit bigger, okay? So in the coming months, when we really start to understand what is growing in the fields, these carryout numbers are going to change based on what the yield is. Okay, now we're going to break down into the specific commodities. Go.
The projected carryout price,
yes,
or numbers, is that after the speculated usage of new crop?
Great question. So sure, her question is, with these numbers here, what's it based off of? So this is the USDA's acres, harvested acres, yield, and all of the demand that the USDA thinks is going to happen next year. Awesome question. Okay. Okay, so here's the skinny on corn, and I updated these slides as of last night. So these are all current prices. This is a front month chart of corn futures in Chicago. So everything I'm going to talk to you about today is Chicago prices. Your local cash market is a little different. And if you are from western Iowa, you probably still have good prices because you have very little corn from last year. Central Iowa, I think you have pretty decent prices yet for old crop just because of the demand situation and things are still probably headed west. And eastern Iowa, you're kind of lucky. You've got it pretty good. You do. You really do. So that's fantastic. But let me show you what you're looking at. So going back to 2004, every vertical black line on here represents the high price and low price of corn in Chicago on the Board of Trade. So that's what you're looking at. These are Chicago futures prices. You can remember we had our first glance up close to $8 corn, and then we have 2 years of crap. And then we have a 2-year price spike, and then this This is important. I'm going to refer to this as the pit of despair. So if you are a fan of Princess Bride, pit of despair. I'm I'm just a little too casual. I'm having too much fun. It's good to be with ladies. Okay. So the pit of despair. So this is what happens we have low prices because we had here in the United States many years of good crops. We did. And there was not a lot of weather drama happening around the world. So supplies were big. Carry out was big. When carry out, ending stocks, leftovers are big, prices are down. Okay. And then, here's what happened in 2020. The China trade deal started to go into effect. And conveniently, after that derecho storm, China, of course, was checking out our satellites and realized, oh, those bins are all empty that blew over. Oh, a fifth of the crop of Iowa is gone. Yeah, we're going to agree to that trade deal right now. Okay? Plus it was $3 corn. So then we have a demand-led market. And then it turned into supply issues because the weather wasn't great. And then it was a war the next year. And now we are on the slippery slope lower. Because now the perception is that the Americans are going to save the day, and there's going to be a decent-sized crop out there. So that's why we have prices sliding lower right now. What's important to watch is right now for corn prices, if they can stay above $5 or not. If they cannot stay above $5, and when I'm talking $5, I'm talking board price, Chicago price. It's a slippery slope lower, and the next big support area is $4.50. That happens if the trade actually thinks that what's growing out in those fields is good enough. Corn planted acres in this country, you know, when you have $7 corn for a couple years in a row, farmers respond. We planted more acres. So this is acres going back to 1987, millions of acres. Of course, it's been trending higher. The yield is what's in question right now. Of course, the USDA has this crazy big number out there right now. And there's a USDA report next Friday. Whatever they say on that report is what we're stuck with for another month. So right now they've got yield up here like 177. It's a big number. It would be a record number. And the trade industry doesn't think it's that high. The traders right now, the industry chatter is that it's probably somewhere between 172 and 175. Okay? So here's the deal. If the USDA gives us a number of 175 next week, the good news is that they're acknowledging the situation in the fields. It's probably not a record crop. You see all the tip back on social media. You know, driving here from where I live in Wisconsin, the crop, it doesn't look robust. It just looks like a skinny freshman teenage boy. To me, that's what it looks like. No offense. I've driven this route for over a decade. You know, coming here from market to market, and this is not a normal crop. This is not the Iowa crop that I know it is capable of. So I know it's not a record yield out there. But if the USDA only says 175, well, you know, it brings the production down, but 175 doesn't make carry-out, ending stocks, leftovers, smaller than 2 billion bushels. Okay? If they put it at 172 or 173, that helps. That would leave carry out at about 1.7 or 1.8. Okay, and that keeps us to have a reason for prices to stay above $5. Okay, now on this report next Friday, the USDA does not have boots on the ground and in the fields. So they are still using old school methodology and a smidge of satellite imagery and some farmer survey and a little bit of magic to come up with their yield number, okay? So just be ready for that. I'm not expecting them to give us anything bullish because, in my opinion, they are still trying to fight inflation also. So they're not interested in higher food prices. That is my opinion. Okay, so U.S. corn production. We're going to be producing over a 15 million bushel crop most likely, unless we get a surprise on the yield. So we are going to grow over 15 billion bushels, but this is the first year in a long time that we are going to overgrow what we are expected to use. So between domestic use, that's the orange, domestic use is ethanol, feed, food, seed, residual. The blue is exports. Our exports are down. Exports are down because the price of corn had been high, and we have some major competition from South America. So I'll talk about that in a second. But we actually are in a situation where, because we have lost demand in the export front, if this yield ends up being 174 or 175, I am sorry to tell you I don't have a friendly story to give you. That's just the reality. Here's the exports, and this is important. So in 2012, that was the drought, and we did not have a lot of corn to export. That's why exports were down. Here is 2020, when China came in and bought like crazy. And now, with higher prices, exports have come down. So this next year, the USDA thinks that exports will improve from the previous year, but it is not kind of back up to our normal mark. And my concern is that with the competition we have from South America, I'm concerned that it might be lost for a while. Here's another visual of ending stocks for corn. Ending stocks, carry-out, leftovers. So you remember, oh, sorry about that. Remember the pit of despair in 2015, 16, 17? Low prices? We had huge carry-out. We had prices $3.50 corn, right? $3.50 corn. Okay, so the USDA is trying to say to you, everything's fine. Okay, so if this ends up being true, I just thoughtfully want you to understand where the price of corn, probably not this fall, but maybe the next year, could be potentially heading. If this perception in reality of bigger supplies is legit. So that is what the world is seeing right now. The world is seeing everything's fine in America. It's going to be great. So they're not bidding up. Why would they? Because everything's fine. So it's going to take a supply threat. If the world finds out that the yield in the fields is less than 171 or 172, you'll see the buyers come in quick because they want to get corn while it's cheap. But if they have reason to believe that the yield is bigger, they're not going to come in. They're only going to buy as needed and wait till the price bleeds and goes lower, and then they'll come in and buy. So just be aware. Now here's where corn is grown in the world, and this is one of my favorite slides, because I do want you to know how much the United States matters. We grow a third of the world's corn. China grows 22% of the world's corn. Everything that China grows, they use, and now they have to import. This is how much corn Brazil grows. So 10% of the world's corn. Not as much as us. Europe, Argentina, Ukraine, Southeast Asia, South Africa. Okay, so a couple things to point out here. You can see how most of the world's corn is grown in the northern hemisphere. Okay, that's important to know because China really got a little nervous last year after the war happened because they were used to just always being able to get corn from us in Ukraine. And now they're like, oh, we should probably make sure that the South American countries have incentive to grow corn. So that way they can get corn year-round, right? Southern hemisphere grows corn at the opposite time that the northern hemisphere grows corn. So they are buying more from Brazil. They are buying from South Africa because they need to keep them happy, so they keep growing corn so China can always make sure that they have corn when they need it. They have to be able to have corn year-round. Now here is Brazil. I want you to go back and look at this. So here's the US production, so we grow a lot. Brazil, not as much. But in terms of exports, this is how much Brazil is exporting compared to the United States. So they grow less corn than us, but about half of what they grow, they export. That is our competition, and that is going to be continued competition going forward. Okay, let's talk about China. China has been, so orange is production. So they continue to be able to grow more corn because they have better production practices. They are growing 275 million metric tons. That was remember that piece of the pie that I just showed you? I mean, they grow a lot of corn. But everything they grow, they use. So they actually use closer to 300 million metric tons, so they have to import. China is going to continue to be a net importer of corn. So last year, they imported a little bit less because of the war, and they stayed on COVID lockdown a little longer to make sure that they could maybe have demand be down. But overall, they're going to need to be a net importer of corn, and I think that will continue to grow now, especially that they have Brazil trained to also grow corn. Chinese ending stocks for the past few years have been pretty consistent, so they say, who knows what's really happening over there. But a good portion of the world's ending stocks of corn are in China. Global corn production, quite frankly, since the past 1, 2, 3, 4, 5, 6, 7 years, we use all of the corn that we grow in the world every year. We use it up. And there has not been huge crops the past couple years, that's why we've had higher prices. So we're at this point of, if the world suddenly has good crops again, and we have good weather, then we'll have a surplus of corn on the world, and that makes prices go down. So remember that balance slide, that balance scale? Okay, so the crude oil prices are getting ready to break out. Notice global supplies of corn are getting ready to break out. They're either going to break out and we're going to have bigger ending stocks, depending on what's growing in our fields, or this number is going to come down. So a lot of things to be aware of going forward. And this is the slide we just looked at. And now here's the top global exporters of corn. So Brazil is number 1, we're number 2. But look at Argentina. They don't grow a lot of corn. So now this is the USDA assuming next year's crop. So Argentina just came off a drought. So this is the USDA telling the world, everything's gonna be fine. Okay? So they're assuming Argentina production is great. They're assuming that South American production next winter is gonna be great. Ukraine still is able to export. South Africa, Russia, European Union. So we still matter, but South America, chomping at the bit, right behind us. All right, so now let's get into the price forecasting. I'm assuming that everybody on the rallies that we had recently had an opportunity to forward contracts of corn for fall delivery. So this is a chart of December Chicago futures. This is what's growing in the field that you are going to be delivering at harvest. That's what this price represents. It's a daily chart. A couple things to point out. This is a trend line that actually comes down from last summer's high price. So some of the best marketing opportunities that we had were last winter in January. And then prices just kind of crept lower, 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 lower. And this red line is 490 price support that went back a couple years past. And I sent out an email and a voice broadcast to my clients, and I said, don't freak out. Prices are going to come back. My target is 570. I think we'll get back to the high end of the downtrend line. We still have to get this crop in the ground. Something's going to happen, so don't panic and sell yet. Okay, so prices were able to move higher, and then you have a June that is hot and hot temperatures, and we had a nice spike up. And the spike up went to a high price from about a year ago. So that was a resistance line. And then everything crashed and fell apart. So this day is early June. It's important to remember that. Prices were at $6.25. A lot of people probably could have forward contracted $6 corn. I think people made some sales in some capacity there. Okay, then everything hits the skids. And then we have our July weather rally, because that's usually what happens every year, the 4th of July. Prices got back up to this downtrending line, touched this little 200-day moving average, didn't have a fundamental reason to go higher, and so just in 7 business days we lost 70 cents. It's brutal. You have to watch the markets every day. So now here we sit, back at this red line. Prices probably don't do too much until next Friday's USDA report. 490 is good support for now, but just remember on that report next week, we need the USDA to give us something friendly. If they don't give us anything friendly, prices just kind of, they're going to slide lower. And the downside target is 450. And I just want you to be aware of that. But if we can get something friendly from the USDA next week, we'll probably get a recovery bounce right back up to this 535 area. Maybe 550 at most. So this is an important support line to be watching. Here's another way to look at it. Here's that same chart, but I'm taking you back. So now it's a weekly chart of corn prices. So you can see after the war, we had higher prices, but we have not been able to get above this downtrending line. One little blip. So that is what we call resistance. So when you hear us on TV talking about resistance, this is what I'm talking about. This is support. Support because it's holding us up. We're at a really critical juncture. Huge. Huge. Like for the next year or two, this is it. This is the balanced scale. We are at it. We are ready to either be really bearish, or things are going to hang in there, and we'll still be able to have 5 to 550 corn into the end of the year. That all depends on what's growing in those fields. Okay, and if you have thought about December 24, you can still get $5. Think about it. It's a little tricky to be pricing when you don't know what all your inputs are. But just start thinking about it. Now I want to, real quick, talk about the value of puts. So this is, I'm going to break away from a very simple conversation to a little bit more complex. Because there are, if you're concerned about, you want to protect unpriced bushels, but you don't want a forward contract, that's when you buy a put and you give yourself a price floor. Okay, there are some people in the industry who say puts expire worthless, but when you hear them say that in their conversations, when they are really trying to be nice and not give this person away, He never says, or he says, under his breath, if held till expiration. So that's his whole shtick. So he says, puts mostly expire worthless if held till expiration. But I want you to know that puts work, okay? So remember in June when we had that price spike? We had 625 futures. And there were a lot of people who were looking at their field and they said, I am not interested in forward contracting. I don't know if I'm going to grow a crop. So I talked with them about buying a put. And I said, well, you can buy a $6 put right now. It's 40 cents, which that's how much an at-the-money put costs in summer. That's normal. So it's 40 cents on 5,000 bushels, $2,000. And if the price of corn goes up, you bought insurance that might expire worthless if the price of corn is higher than $6 at expiration. And that put on June, when we had that price spike to 625, was trading at 40 cents for about 3 days. Okay, and then the price of corn crashed, $1. And that means the value of the put got bigger, and the value of the put went up to $1.20. So you could have, if you wanted, taken the money and run, because then the market price went back up into July. If you said, I don't want to spend 40 cents, if you said, I had a couple clients that said, I just want to do it just in case, I'm going to buy a $5 put. And I said, all right, that's fine, that's like 10 cents. Here's, you need to know your realistic expectation of return. But they saw a return on that investment. It went from 10 cents to 40 cents. So there are opportunities with puts. You need to also be able to walk away and take a profit and not necessarily hold it till expiration. Find a strategy appropriate for you. I just had to get that in there because they are helpful tools. Soybeans. Long-term uptrend support. This is front month beans. So beans still have a friendly story. Long-term uptrend support. And just like corn, we're having a hard time getting above this downtrend resistance line. Prices crashed lower, we had a recovery bounce higher, and now things are kind of starting to slide again. So I'm assuming most people probably don't have old crop beans left over. Yes, go ahead.
Is any of this reflective in the markets with the sustainable aviation fuel that they're talking about?
The sustainable aviation fuel and the growth that's coming is coming up in about 8 slides.
Okay.
Perfect. Beans are the friendly
I
story.
just segued for you.
I love it. Perfect. I planted her with that question. Okay, so soybean prices for old crops still looking pretty good, right? And the new crop story is friendly also because the USDA surprised us all and gave us a lower planted acres number. Now remember, this soybean number, it has the ability to change because that acres number also included double crop wheat to beans. So some of those have yet to be planted, some did get planted in southern Illinois. So this might be a revolving number for acres. The yield, this is going to be the huge question. This is my first time making this trip where I could still see in between soybean rows. They haven't fully canopied over. So that was different. So I'm very interested to see what's out there for yield. Soybean production, we are growing about 4.2 billion bushels, and we use every single bit of it. Half of what we grow, we export, half of what we grow is for the crush. The soybean story is friendly and getting friendlier. Now, exports for soybeans are down, of course, because of higher prices and also because of competition from South America. But, dun, 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 here it is. Here's the friendly story. So these are crush plants coming on, the new demand from biofuels. This is a friendly story. And so the USDA has slowly been accounting for the increase in demand. They won't put all of it on one report. They're kind of making sure these plants are coming online. But the crush story and the U.S. domestic demand story is phenomenal. So that is what's great because it will offset any export loss that we might have to South America. So thank you to all the people who are involved in building that demand and making this friendly story so that American farmers have another outlet for their soybeans. It's a really fantastic thing. So that is a demand story that's going to continue to grow. Soybean ending stocks. See this bean picture? We're not out of the woods yet. We have carryout pegged at 300 million bushels right now for what's growing in the fields. And the USDA has like a record yield number. And I'm thinking, we have 2 weeks of cool weather coming. So I checked Fargo, Des Moines, Springfield, and after this weekend, everybody has 2 weeks of low 80s. So that's helpful for soybeans. But it's hard to know that it would actually be a record out there. So the soybean story, I'm friendly. But here's where you gotta be aware of. So now, who's the big boss? Brazil, okay? And this is Argentina for next year, assuming they start to get back to normal production, and this is the United States. China does grow a little bit of beans, but they need to overall be major importers.